In this video, we are going to talk about abnormal returns, equilibrium, and arbitrage. Let's start with abnormal returns. Now, this is just one example of identifying abnormal returns. There are many other ways. This is just one of them. So you may see in other places and or different scenarios, different approaches. In this case, we're going to use CAPM compared to the expected return in order to see if there's abnormal returns. CAPM will represent the required return in this case. So we have some information here. You consider buying a share of stock at a price of $25. Stock expected to pay a dividend of $1.50. And then the stock is expected to be at $28 in a year from now. And then they give us some other information, beta, risk-free rate, and the market return. So what is the stock's abnormal return, if any? So we know that the price is $25, price is times 0. We know that within the next year, a dividend of $1.50 will be paid or expected to be paid. And there's an expectation of the stock price to be $28 in a year from now. The beta, risk-free rate, and the market return. So the first thing we want to do is calculate the expected total return of the stock. So what you do is you take the price that you expect it to be in the future, $28, that's C5, so that if you were to sell the stock, you will receive $28. Sometime throughout the year, you received $1.50 in dividends. And what you paid for was $25. So we add the price in the future you can sell it for, if you get that money, the dividends, because you receive that as well, but you take away what you paid, and then all those three calculations, you divide it by what you paid. So it's the same as new minus old divided by old. We just have to add the dividends in there as part of your new money coming in. So that gives you an expected return of 18%. Then we have the required return. This is what you should get based on the risk of the stock. So you use CAPM, which is the risk-free rate plus the beta multiplied by the market premium being the market return minus the risk-free rate. So you follow this formula, and that gives us the CAPM formula and tells us 17%. And then all we do is we take the expected return minus the required return, and it appears that the stock is expected to give us 1% above the required. If it holds true, then there will be an abnormal return of 1%. If the expected return was less than the required return, then you will have a negative abnormal return, and you can say abnormal loss or something in that line of vocabulary. And that's how you calculate abnormal return with on the method of comparing required return versus expected return. Now let's talk about equilibrium. In a simplified way to explain what equilibrium is when you have two different assets with two different risk profiles. So we do know that the higher the risk, the higher the return should be. We also know that the lower the risk, then the lower return. So it does make sense that this number, the 9.50, is less than the 14% because the risk is lower. However, the question is that difference justified by this difference? if they follow the same rate of change based on, of course, the risk-free premium, the risk-free rate involved, then you will say, yes, they are in equilibrium. So what we do is we apply this formula. You take the expected return minus the risk-free rate, and you divide it by the beta. And that's going to give you a reward to market risk ratio. Then you do the same over here. You take the expected return minus the risk-free rate divided by the beta. If they both have the same market reward to market risk ratio, then yes, they are in equilibrium. They're both behaving as they should in comparison to the market. Now, what happens when these are not the same? Then you're not in equilibrium. And when you're not in equilibrium, then there's an arbitrage opportunity. In this case, the way to take advantage of the arbitrage is that when the reward to market risk ratio are not the same, you want to take a long position. You want to invest in a long position in the one with the higher reward to market risk ratio. And then you want to take a short position on the one with the lower reward to market risk ratio. And what happens, you receive the cash from the short, you use it on the long. And then when the averages play out, you make money by what you cash in on the long position, and you cover your short losses, or vice versa. The point is that you take advantage of the differences. And the strategy is take a short position here and then with the lower one, and a long position here for the same amount. And when the averages play out over time, you would have made money. And it's called arbitrage because you never used any of your money. It was zero investment on your side. You took the money that came in from the short position and used in the long, and then paid your losses. So one of them is going to lose, one's going to make money. You pay the losses of one with the earnings of the other, but you're going to make more money in the other one. And so you're going to have some left over. But you do the same calculation that you did in the equilibrium calculation. And when they're not the same, that's how you do it. And that answers the question here. If you want to take advantage of an arbitrage opportunity, you should take a short position in portfolio B and a long position in portfolio A. That's how you answer the question in there. Here is another scenario, the same process. Once you identify the reward to market risk ratio, you look at if they're not the same, then you have an arbitrage opportunity. Look for the one with a higher ratio. That's your long position. The one with the lower ratio, that's a short position. And you end up making money without having to put any of yours. You took the money from the short and you got in the long. This only works when the reward to risk ratio are not the same. If they're the same, there is no arbitrage opportunity. The logic behind it is that the market will always go towards equilibrium. So but sometimes they're off, like here and here and here and here. So when they are off, they will start moving towards equilibrium. And in that movement, one is going to make money, one is not. So you pay your losses with the one that does make money, and you're left over with some money without ever having to put any of your money there. That's it for this video. See you in the next one.